Yeah, not looking bad at all. GMDC is up 5% as well. But a quick view here, Mayuresh. IFL Securities, and we'll make this quick. IFL Securities is down 3.5%. This is my last question, really. But capital market plays have delivered a very solid quarter. Mayuresh, quick 60 seconds. Are you a buyer into capital market companies?
So asset management, yes, on declines, Niraj, because I think the show has been solid. The expectations largely, at least being built in and baked in right now, are that SIPs will continue flowing in to these asset management players. And as India evolves over the next few years, what we've probably seen in terms of these asset managers, if you go through the presentations of most of the wealth managers as well, Anandarati Wealth, you've got IFL Wealth as well, which is 360 WAM. I think if you look at the pyramid and the trajectory in terms of the Indian households that can actually move up the value chain in terms of discretionary incomes over the next few years, I think there is a huge scope in terms of professional wealth managers actually doing well over the next few years. So yeah, I think asset management as a space is something that we can do.
Both of you, thank you so much for taking the time out and being with us. Really appreciate your time this morning. Okay, so that's the view from our experts for the morning. But small caps under a bit of a cloud. Today might be a respite. Is this the end of the pain? Is it possible to even say that? Manish Sonthalia, Chief Investment Officer at MK Investment Managers, joins us right now on the show. And Manish has attended a clutch of investor conferences in the recent past. He's spoken to a clutch of companies which are mid-sized and small-sized. And Manish, my question to you is this the dip that somebody like you might have been waiting to get stocks at better prices? Or can this dip get better for somebody who wants to buy?
So Niraj, 7% correction on the Nifty has created a lot of heartburn, but as we all know, markets don't just move one way. They go through ups and downs. I think it's pleased because a bunching up of IPOs. Yesterday was one such IPO which actually listed at a discount. You'll have a few others like this, a lot of QIPs not getting through. A lot of IPOs coming at a discount. Some sort of a madness in this whole liquidity scramble where everybody is just looking to shore up some of the capital because the markets have been very euphoric. I think some cooling down on this either the FI front in terms of selling or the IPOs getting pushed out will again bring back sanity in the market. I think there's a lot of value in the markets. But as we all say, that India's market has become very broad. Now we have 57 sectors to deal with. We can't just say that Indian markets are overvalued and everything is overvalued, or Indian markets are undervalued and everything is undervalued. There'll be a lot of rotation that will happen. But particularly in mid and small caps, it's not a sectoral call. It is about the individual companies. But I would believe that this dip again should be bought into. India has a long way to go in terms of market cap creation. Many years out, in the medium to long term, there's still money to be made.
Hi, it's also Samina joining in. Completely agree. I think we're all in a consensus view where the long-term story is that India is in a structural bull run. So any opportunity or weakness should be bought into. But what I want to understand from you is from early this year, we've been complaining about how FIs have been dumping India. Now, of course, up until now, the concern was valuations. Now we're justifying it, saying that China has become the giant we need to again start looking out for. But retail participation has supported the market at every dip. Even today, DIs are buying. What do you think is going on? Because if DIs are continuing to buy, FIs have always sold, then where is this pressure coming from? And if DIs are selling, what are they doing with the cash is what I want to know, because most were sitting on piles of some dry powder to allocate when the opportunity arises. So I'm just confused of what is going on operationally in this market.
So a few things out here. Obviously, FIs have been selling for quite some time. And new money into Indian markets, roughly speaking, closer to around 10,000 crores of continued SIP plus lump sum new money coming into the Indian markets. Every month you get a fresh inflow of 25,000 odd crores. Mutual funds have been sitting on closer to 2 lakh crores of cash. I mean, that's perfectly fine. And Indian markets were going good. Liquidity was tight. That was the stance maintained by the Central Bank of India, which is basically RBI. But now liquidity has also started easing at the margin. What is suddenly changed is this $10 billion worth of IPOs. And it's not to say that this will not get normalized, but suddenly everything is coming together. First of all, we are in the middle of the earnings season. Numbers that have come out so far have not been that great. Secondly, 1 lakh crores plus of selling that has already been done by the FIs in this month. So 17, 18 days of this month, there's a lot of selling. Plus, you had mega issues that were coming out with IPOs and still coming out this month. You had a Hyundai, you had a Vari, you have Afcons, and a plethora of them lined up, totaling $10 billion. On top of that, you have announcements of QIP by XYZ. So I think this is the main problem. It is not about retail investors not looking to buy or retail investors actually panicking. None of that. It's just that too much of outflows have got bunched up together at the same point in time, and that is what is causing a bit of a flutter. And given that rate cuts in the US is also not a given. We all believe that emerging markets will see, increased bouts of flows because China has a problem, so India will be a beneficiary, and because rate cuts will continue in the US, India will stand to gain in terms of flows, but then none of that. Economic data in the US is very, very strong, so really don't know whether this 50 basis point cut out there is going to get followed with another rate cut soon. I mean, you can't assume that. And in India, obviously, rate cuts will happen only in the first quarter of calendar 25, nothing before that. So all in all, that's the major problem. I don't see the medium-term picture getting blurred at all. And, the whole point is that if real GDP growth is between 6.5%, 7%, Prime Minister talks out at your summit in Delhi saying that, investors will make money in the medium to long term. I mean, let's believe that. And, we all have our own sectoral picks and bottom-up stock picking, but that's about it. I don't really think there's any case of major selling or panic in the markets just yet. It is just an ordinary correction within the overall scheme of things. Don't really see how another 5% or more can fall from these levels. We have already fallen 7%. So on the headline numbers, maybe we could fall another 3-4%. That's a given, but nothing more than that is what I'm.
And you're right. It really doesn't matter if you're a long-term investor. Nobody's going to remember this 5% fall or the level they entered the market at when they look back, right? But we've seen quite a bit of the earnings season, and it's been a mixed bag so far. This morning, of course, Niraj and me were discussing how the commentary of a lot of the managements post-closing yesterday seemed positive. Any sector, any stock, or any management that has stood out for you where you would be adding incremental capital to because you're genuinely impressed by their earnings and you're believing in the promise that things will get better going ahead into the second half of this year?
So standout sectoral results coming out from capital market intermediaries. I mean, it's stunning. And I think once you have the numbers come out from CDSL and BSC and all, that would be an icing on the cake. So I think capital market platform companies, wealth management platform is AMCs, broking entities, so on and so forth, they will actually see a massive re-rating. This is one more additional sector to look at. Purely from a wealth creation point of view, it's up for re-rating. I mean, this is one which I can sense is how this whole sector is performing, whatever numbers we have seen so far. I think there are two other platforms that came out with numbers. Again, Zomato was a stunner in terms of positives, and so was the case of Paytm. Again, a lot of incremental positives to take away in both these numbers. So as I've been alluding to in the past also, platform companies are going to be the real wealth creators when it comes to the next 5 years or so in India's context. So that's one. I think technology companies have been a mixed bag. You can't really paint a whole lot of positives out here. Book to bill still remains, but execution is still a challenge. Banking, for the first time, we are actually seeing some PSU banks report NPAs in corporate accounts. We always believe that retail NPA would have seen the trough of the benign credit cycle, but corporate accounts seeing increased NPAs, and RBI has been talking about cautiousness to be maintained on the retail side, MFI, NBFC. So it's a mixed bag of the financials, lending institutions, not so great, and again a mixed bag for your technology companies. But otherwise, it has been a soft quarter. You have a Supreme, etc., which reported numbers, not so great numbers that we have seen this
Manish?
result season. So,
Manish, just one question. We were talking to Supreme yesterday, and con call of Kajaria, a couple of other companies. All of them seem to suggest that elections Q1, excess rainfall Q2, hampered first half. Second half, significantly better. In fact, Supreme went on to say that they will grow 41% in H2 over H1, which is the highest in the last 3 years that they've grown. Of course, a low base of H1. My question is, are the negatives in the price, or do you believe the valuations are anyways too stretched, and therefore these corrective moves don't make this stock, attractive enough?
No, so you're right that there were elections, and there was rainfall, and government's budgetary allocation didn't get spent through. The interim budget of last year didn't get spent through, and now that the elections are over, you have a new budget. Now the roadmap is very clear, and expectations are that spending in the second half is going to be much better than what the spending had been in the first half. That's a given. But I think given the state of uncertainties regarding delivery of numbers, and of course, all of this was well known, and when markets went into expectations in terms of execution from building material companies and pipe companies, they already had some muted expectations. But if the numbers have not come out, even on muted expectation, that has come out as a disappointment. I think, again, the benefit of doubt will go to the companies and the managements who allude to the fact that second half is going to be much better. But I think seeing is believing. Markets will see the numbers and then maybe re-rate the companies. Of course, just an anecdote in this regard was that rural economy is going to turn and is looking much better, but we believe that nothing of that is basically coming through from the rural front as well. Some of the numbers that have come out from Nestle's or even today's HUL don't really paint a picture where rural seems to be coming back, and on top of that you have a very inflationary environment, a reasonably good inflation sort of a situation where margins may be under pressure. So I think consumer again and capital goods, particularly on the government spending side, would be sort of a disappointment in the first half, all well known, and though the benefit of management, but I think markets would only see the numbers in the second half and then maybe take a call in terms of re-rate.
Right, Manish, always great talking to you. We have a good festive few weeks ahead, and we'll hopefully connect back with you in November when things settle a little bit from here on. But good seeing you. Have a good week. With that, thank you. We keep the